If you want to know what's going to happen with the stock market in 2025, you need to keep your eye on the money supply. The Federal Reserve is actively shrinking the money supply. They're now on a trendline basis, but unfortunately, we're starting to get information that is probably going to drive the Federal Reserve to no longer decrease interest rates. This will shrink the money supply further, or at the very least, the growth rate will decline. Because of that, the stock market, which is heavily correlated to the money supply, the stock market through 2025 is likely to shrink in its growth rate, if not decline. These growth rates we've seen throughout the past year are probably over with. Keeping an eye on the money supply, you can see this as a trigger for what's going to happen in the stock market in 2025. I'm going to break that down for you. I'll break down rates of growth so you have an understanding of what will happen to the stock market in 2025. Let's jump in. This is a chart on the actual nominal number for the M2 money supply. M2, of course, is all the money in the money supply. And mostly, M2 money supply has entered a trendline basis, but unfortunately, that trend line is well beyond normal when you start considering 2008. If you look prior to 2008, they did 3 QEs, QE1, 2, and 3. QE4 was, of course, the big jump we see there when the Federal Reserve jumped in for COVID. Prior to that, the trendline growth rate was much lower. So we are on a trendline growth rate prior to, post 2008 financial crisis, but not prior to what the trendline basis was before. Here is a look at personal incomes. You have the money supply. People earn money. This is the nominal rate for personal incomes. One more chart to look at. Here is the S&P 500. All three of these have something in common. They tend to just continue to grow and grow and grow. But we go back to the M2 money supply to understand what's going to happen in the S&P 500 going forward. Here's a look at all three of the charts combined. And as you can see, they're all pretty much correlated pretty heavily. If you look towards the very end, all three lines sort of cross each other, and I felt that was pretty interesting. The S&P 500 is largely well overextended beyond these two lines. That to me is very interesting. Let's break some more things down. Here is the S&P 500 versus the M2 money supply on a year-over-year growth rate. Now, the money supply, of course, is starting to slow down, even though it's not even kind of gotten back up to its normal levels. The growth rate it's been moving up, but the rate of growth is starting to decline because the Federal Reserve had been raising interest rates. They paused. Now they're simply not going to be lowering interest rates even further. That's important. You pay attention to the money supply, you get a good understanding what's going to happen in the stock market in 2025. But what propels the Federal Reserve to make these decisions? Inflation, of course, is one thing. Now, in this chart, this is core PCE, the core inflation rate that the Federal Reserve looks at versus the money supply, except for one thing. I inverted the core rate. And this makes perfect sense. All right, if the economy is moving forward and inflation is in check, the money supply would grow. Inflation would basically move lower. So you would see an inversion there, or the opposite happening. The money supply would go up, inflation would go down. So I inverted this chart to show you that these two are so heavily correlated. All I did was multiply by -1 for the core inflation rate. This flipped it. We're seeing inflation start to move a bit higher. We just got the information last week. The Federal Reserve is not going to be able to lower interest rates at the pace that it had wanted to. And I've been saying this all through 2024 that the Federal Reserve, the economy is simply too strong for the Federal Reserve to lower interest rates at the pace that the stock market wants. We just saw that evidence last week. The Federal Reserve could lower interest rates given all the information prior to November 5th. We have new information that is inflationary. So we're already seeing core prices inching back upward, which would force the Federal Reserve to stop lowering interest rates, and that'll have a direct effect on the S&P 500, the stock market in 2025. Here is a look at the U.S. 10-year Treasury yield. I see 5% happening. What's going on there? All right. Trump's tax cuts are inflationary. Corporations pay about 9% of all the money that comes in for the federal government. U.S. consumers or people in the U.S. economy pay about 45%. So basically, by lowering the tax rate for these corporations, there's an increase in the deficit. They believe that the deficit increased by about 1.5 trillion up until about this point, maybe close to 2 trillion. They're still trying to figure that out. In the meantime, going forward in March, when Trump extends these tax cuts, their expectation is that the deficit will increase by about 4.5 trillion. Who pays for that? While the stockholders, of course, are going to see increased earnings because they're paying less in taxes, it increases the deficit, which falls on American citizens. They pay 45% of what the federal government takes in. So it's inflationary, and we're seeing the U.S. 10-year Treasury yield moving higher. This affects all of the economy across the board. So not only are American citizens going to have to pay for these tax cuts, interest rates across the board are going to continue to move higher for credit cards, car loans, mortgages, things like this. We've seen these interest rates moving higher. This is the 10-year. You're looking at the chart. This acts as a tax on U.S. citizens. Because their income is finite, they're not going to be out there spending as much. So corporations are going to get less revenue. That less revenue, in an environment where the Federal Reserve has interest rates held higher, is going to restrict the stock market in 2025. I look for companies to earn a much lower growth rate in 2025, less profits. The stock market, this move we've been seeing higher and higher, likely played out. For me, it's all about personal incomes. I start looking at personal income growth and I ask the question, how are the consumers doing? If we have more and more individuals being placed on payrolls, they're spending more and more. Incomes increase, expenditures increase, businesses move forward. It's also the money supply. It's sort of the money supply both acts as a cause and effect. If there's no inflation in a fractional banking system, we'll see the money supply continually increasing. Businesses are out there borrowing money. Citizens are out there. American consumers are borrowing to buy more and more. This propels the economy forward. But higher interest rates act as a tax on finite incomes. We're going to see expenditures start to decline. Because of that, we'll start to see businesses pulling back on investments and moving forward with hiring. Because of that, we'll see a restriction on the overall economy. The fractional banking system means that the money supply will stop its accelerated growth rate, moderate, probably move lower. You saw the chart on the stock market. If we see the money supply continue to shrink through 2025, we'll see incomes and expenditures shrink as well. The S&P 500 through 2025 will start to decline. We've seen some extraordinary moves higher. it's a few stocks. There are some stocks. We're actually getting NVIDIA, as I think they report on Friday, I believe it is, should be a huge market mover. But the broader market itself isn't participating in this big move higher. And in fact, with the money supply moving forward in 2025, I see the stock market starting to decline, broadly speaking. Sure, you're going to get some outliers that are going to just keep on going. However, the taxing of the consumer is going to have a direct effect on the money supply and consumers. Revenues for companies throughout 2025 are going to start to decline. Because of the decline and the shrink of the growth rate in the money supply, because of inflation being a little higher than normal, Federal Reserve keeps interest rates higher. Because of the tax cuts from the Trump tax cuts themselves, we're already seeing the 10-year Treasury yield moving higher. This continues to act as a tax across the board on consumers. Keep an eye on the money supply, and you have a good idea, the rate of growth of the money supply, you have a good idea of what's going to happen with the stock market in 2025. I'm going to continue to watch this because the money supply to me, along with personal incomes and expenditures, the very beginning of the economy. You follow the money supply, you follow personal incomes, you follow expenditures, you have a good idea of what's going to happen with the stock market in 2025. I see it declining. See you in the next video.